$2.9 million. That is what the SEC forced Oppenheimer Asset Management to disgorge after its portfolio managers used client commissions to pay for office rent, furniture, and personal expenses. The managers directed $2.6 million in client trades to generate soft dollar credits, and then spent those credits on themselves. This is not a hypothetical. This is the exact scenario the CFA exam tests you on, and if you cannot identify the violation in 5 seconds, you will fail this section. So what exactly are soft dollars? When a portfolio manager directs client trades to a specific broker, that broker earns a commission. Soft dollars are an arrangement where the broker uses a portion of that commission to pay for research or other services that benefit the manager, instead of rebating it to the client in cash. Think of it as, the client pays the broker pays the vendor, the manager gets the research. The client's money flows out through commissions, the manager receives a benefit, and therein lies the conflict. The key question on the exam is always, who actually benefits from the arrangement, the client, the manager, or both? The legal framework governing soft dollars in the United States is Section 28E of the Securities Exchange Act. This provides a safe harbor protecting managers from breach of fiduciary duty claims under U.S. law, but here is the critical exam trap. Section 28E, compliance does not automatically satisfy CFA standards. They are two entirely independent frameworks. A soft dollar arrangement can be legally protected under 28E and still violate the CFA code and standards. The exam explicitly tests this distinction. When you see a question that says the arrangement is legal under Section 28E, that tells you nothing about whether it satisfies CFA standards. You must apply both tests independently. So what actually qualifies as permitted research under a soft dollar arrangement, and what crosses the line? The test is direct benefit to the client's investment process. If the research is actually used in making portfolio decisions for client accounts, it qualifies. If it primarily benefits the manager's business or personal activities, it does not. Look at the table. Real-time market data feeds, third-party analyst reports, portfolio analytics software, execution analysis tools, all directly aid investment decision-making. These are permitted. But office rent, personal computer hardware, marketing software, travel and entertainment, administrative salaries, these benefit the manager's business operations, not the client's portfolio. They are prohibited. The decisive question is, does this research actually get used in managing client assets? Not, could it benefit clients someday? But, is it actually used right now for client portfolios? Now let's tackle the hardest concept on this topic, the mixed-use problem. What happens when research benefits both the manager and the client? This is where most candidates lose points. The answer is a 4-step proportional allocation process. Step 1. Estimate the percentage of use attributable to client investment decisions versus manager personal use. In the exam question, you will usually be given this split explicitly. For example, 70% client benefit, 30% personal benefit. Step 2. The client benefit portion may be paid through soft dollar commissions. That is the legitimate use. Step 3. The personal benefit portion must be paid in hard dollars, meaning cash from the manager's own pocket, not from client commissions. This is the rule candidates miss. Step 4. Disclose the entire arrangement to clients, including the allocation methodology. Disclosure without the hard dollar payment is not enough. Both are required. The exam trap. Candidates think disclosure alone cures the mixed-use problem. It does not. You must pay for your share in hard dollars. Let's walk through the disclosure obligation under Standard VI. A. The exam frequently presents scenarios where a manager does something technically correct, but discloses it poorly, or discloses it, but fails to take the required substantive action. Here is how a compliant disclosure process works step by step. Step 1. Identify the conflict. Soft dollar arrangements, directed brokerage, referral fees, any arrangement where the manager's interests could diverge from the client's interests must be identified and treated as a conflict requiring disclosure. Step 2. Disclose before the relationship begins and update when material changes occur. Disclosure must be timely, specific, and actionable, not buried in footnotes. Step 3. The disclosure must describe what the arrangement is, who benefits, and how client commissions are being used. Vague language like, "we may use soft dollars," is insufficient. Step 4. For mixed-use arrangements, the disclosure must also state the allocation methodology and confirm that hard dollar payment will cover the personal use portion. Remember the exam rule: disclosure is necessary but not sufficient. It is the starting point, not the ending point. Now let's cover directed brokerage and the best execution conflict. This is a separate but closely related exam topic. A portfolio manager has an obligation to seek best execution on every client trade. Best execution is not the lowest commission. It is the best overall terms considering price, speed, likelihood of completion, research value, and market impact. This multi-factor definition is one of the most tested wrong answer traps in the ethics section. Step 1. The manager directs trades to a broker. The manager must evaluate whether this broker provides the best overall execution for the client, not just whether the commission is competitive. Step 2. If the client directs brokerage, meaning the client tells the manager which broker to use, the manager must still seek the best available execution through that broker. Client direction modifies the destination, not the obligation. Step 3. If the directed broker cannot provide best execution, the manager must inform the client of this limitation and document the client's acknowledgement. Complying with direction while abandoning execution quality violates Standard Roman III-A. Step 4. The most dangerous exam scenario is when a manager directs all brokerage to a broker who provides research and pays above-market commissions to do so. This is permissible only if the research benefit to clients justifies the commission premium on balance. Let's test your understanding. Pause and think before the answer reveals. A portfolio manager directs 100% of client trades to broker X, which charges commissions 15 basis points above the market rate. In return, broker X provides economic research reports used exclusively in managing client portfolios. The manager discloses this arrangement to clients annually in writing. Under CFA standards, this arrangement is most likely permissible because the manager disclosed the arrangement. B. Permissible provided the research genuinely benefits clients and best execution is satisfied on balance. C. Prohibited because the manager directs all trades to one broker. D. Prohibited because paying above-market commissions always violates best execution. The answer is B. Disclosure is necessary, but not sufficient on its own. That eliminates A. Directing 100% to one broker is not per se prohibited. That eliminates C. Best execution is not a lowest cost standard. That eliminates D. B is correct because the research directly benefits clients, the arrangement is disclosed, and the commission premium can be justified by the research value if it represents the best overall terms. Next question. This is the mixed-use scenario that trips up the most candidates. A portfolio manager receives research from broker Y paid for through soft dollar commissions. 40% of the research is used for client portfolio decisions. The remaining 60% benefits the manager's personal investment activities. Under CFA standards, the manager must pay 60% of the cost in hard dollars and use soft dollars only for the 40% client portion. B. Disclose the mixed use to clients and continue paying 100% through soft dollars. C. Discontinue using soft dollars entirely since the research has mixed use. D. Obtain client consent for the mixed use arrangement and continue as is. The answer is A. This is the proportional allocation rule. The 60% that benefits the manager personally must be paid in hard dollars. Client commissions cannot fund that portion. Disclosure alone is not sufficient. That eliminates B. The standard does not require discontinuing mixed-use research entirely. That eliminates C. Client consent is not a safe harbor for using client commissions to benefit the manager. That eliminates D. Question 3. Directed brokerage and client consent. A client instructs her portfolio manager to direct all brokerage to a specific broker as compensation for referring new clients to the manager's firm. The manager follows these instructions. This arrangement most likely violates which standard? A no violation because the client authorized the arrangement. B. Standard Roman III, A. Loyalty, prudence, and care. C. Standard VI, A. Disclosure of conflicts only. D. Standard Roman IV-B, additional compensation arrangements. The answer is B. Even though the client is directing her own brokerage, the arrangement uses the client's commissions, her assets, to pay for referrals that benefit the manager's business. The manager's fiduciary duty cannot be overridden by client direction when the arrangement exploits the client's assets to benefit the manager. Client consent is not a safe harbor here. C is wrong because disclosure does not address the substantive loyalty breach. D is wrong because the primary issue is the duty of loyalty, not compensation from employers. Question 4. Identifying permitted versus prohibited soft dollar uses. Which of the following services paid for through soft dollar commissions would most likely be permissible under CFA standards? A. Office rent for the portfolio management firm's headquarters. B. Computer hardware for the manager's personal home office. C. Real-time market data, feeds used by portfolio managers to make investment decisions. D. Software used to produce marketing materials for the manager's firm. The answer is C. The direct investment benefit test, real-time market data that portfolio managers actually use in making investment decisions for clients passes the test. It benefits clients directly in the investment process. Office rent is general overhead. It benefits the manager's business, not specifically clients. Personal hardware is a personal expense. Marketing software benefits business development, not client portfolios. The distinction is always between directly aids investment decisions for current clients versus benefits the manager's business operations. Question 4. Identifying permitted versus prohibited soft dollar uses. Which of the following services paid for through soft dollar commissions would most likely be permissible under CFA standards? A. Office rent for the portfolio management firm's headquarters. B. Computer hardware for the manager's personal home office. C. Real-time market data, feeds used by portfolio managers to make investment decisions. D. Software used to produce marketing materials for the manager's firm. The answer is C. The direct investment benefit test, real-time market data that portfolio managers actually use in making investment decisions for clients passes the test. It benefits clients directly in the investment process. Office rent is general overhead. It benefits the manager's business, not specifically clients. Personal hardware is a personal expense. Marketing software benefits business development, not client portfolios. The distinction is always between directly aids investment decisions for current clients versus benefits the manager's business operations. Question 5. The step-out trade structure. This one trips up candidates who have not studied soft dollar mechanics. A brokerage firm offers portfolio managers a step-out arrangement. The manager executes trades through broker A, but directs a portion of the commission to broker B, which provides research. Under CFA standards, this arrangement is permissible if the research benefits clients, total commissions are reasonable, and the arrangement is disclosed. B is prohibited because the manager cannot split commissions between brokers. C is prohibited because best execution requires using a single broker. D is permissible only if the client pre-approves each individual step-out. The answer is A. Commission sharing arrangements, also called step-out trades, are an explicitly recognized form of soft dollar arrangement. They are permissible when the research from broker B benefits clients. The total commission paid to broker A remains reasonable given the combined value of execution and research, and the arrangement is disclosed. Splitting commissions between brokers is not per se prohibited. B is wrong. Best execution does not require a single broker. C is wrong. Per transaction approval is not required. A general disclosed policy is sufficient, eliminating D. Question 6. The double standard trap. Candidates who only identify one of the two violated standards lose full credit on these questions. A portfolio manager uses soft dollar commissions to purchase research. 70% of the research directly benefits client portfolios. 30% is used for the manager's personal investment analysis. The manager discloses the arrangement to clients but does not pay hard dollars for the 30%. Which standards are most likely violated? A standard VI, A only because the arrangement was disclosed. B, no violation because disclosure was made. C, standard Roman III, A only. D, both standard Roman III, A and standard VI, A. The answer is D, both standards are violated. Standard Roman III, A loyalty is violated because client commissions are funding personal research, using client assets for manager benefit. Standard VI, A is also violated because the disclosure, while present, is incomplete. A compliant disclosure must include the allocation methodology and confirm that hard dollar payment covers the personal use portion. Disclosure without the allocation detail is an inadequate disclosure. This is the double standard question the exam uses to separate strong candidates from average ones. Question 6. The double standard trap. Candidates who only identify one of the two violated standards lose full credit on these questions. A portfolio manager uses soft dollar commissions to purchase research. 70% of the research directly benefits client portfolios. 30% is used for the manager's personal investment analysis. The manager discloses the arrangement to clients but does not pay hard dollars for the 30%. Which standards are most likely violated? A standard VI, A only because the arrangement was disclosed. B, no violation because disclosure was made. C, standard Roman III, A only. D, both standard Roman III, A and standard VI, A. The answer is D, both standards are violated. Standard Roman III, A loyalty is violated because client commissions are funding personal research, using client assets for manager benefit. Standard VI, A is also violated because the disclosure, while present, is incomplete. A compliant disclosure must include the allocation methodology and confirm that hard dollar payment covers the personal use portion. Disclosure without the allocation detail is an inadequate disclosure. This is the double standard question the exam uses to separate strong candidates from average ones. Here is your complete soft dollar and brokerage conflict decision framework. Pause this screen and screenshot it now. These are the rules that will appear on your exam in disguised form. Rule 1. Soft dollars are permissible when research directly benefits clients, is actually used in their portfolios, and is disclosed, not when it merely could benefit clients theoretically. Rule 2. Best execution is a multi-factor standard, not lowest commission. Speed, certainty, research value, and market impact all count. Rule 3. Mixed-use research requires proportional hard dollar payment for the personal portion. Disclosure alone is not enough. Rule 4. Section 28. E. Compliance does not satisfy CFA standards. They are two independent tests. Rule 5. Client-directed brokerage does not eliminate best execution obligations. the manager must still seek the best available execution through the directed broker. Rule 6. If a directed brokerage arrangement benefits the manager at the client's expense, it violates Standard Roman III-A, even with client consent. Rule 7. Disclosure must be specific, timely, and include the allocation methodology for mixed-use arrangements. Vague boilerplate disclosure is insufficient. Screenshot this. These 7 rules will answer every soft dollar question on your exam. Now your exam strategy for this topic. Standard VI, A, and Standard Roman III-A questions on soft dollars appear in every CFA Level I exam window. They are high frequency, high difficulty, and high reward. Strategy 1. Whenever you see the word disclosure in an answer choice, immediately ask yourself, is disclosure sufficient here, or does a substantive obligation also exist? If there is a mixed-use problem, loyalty breach, or best execution failure, disclosure alone is always wrong. Use this to eliminate 1 or 2 wrong answers in under 5 seconds. Strategy 2. Whenever you see best execution in the question or answer choices, mentally flag that best execution is multi-factor, not lowest cost. Eliminate any answer that equates best execution with the lowest commission. Strategy 3. On double standard questions, where the scenario clearly involves using client assets for manager benefit, always consider whether both Roman III-A and VI-A are simultaneously violated before selecting an answer that names only one standard. Strategy 4. When Section 28E appears in a question stem, treat it as a red herring. The CFA exam tests CFA standards, not Section 28E. A statement that something is legal under 28E does not mean it satisfies CFA ethical requirements. Time allocation. Spend no more than 90 seconds on any single soft dollar scenario. Apply the client benefit test, the hard dollar rule, and the disclosure completeness test in that order. You will get it right.